Let's talk money, honey. The financial system is like a giant machine that keeps the economy humming. It's how money flows from people who have it to people who need it. Think of it as a network of pipes and pumps. Instead of water, it moves money. This system is essential because it allows businesses to grow, people to buy homes, and governments to fund important projects. Without a well-oiled financial system, our economy would grind to a halt. We need it to function, to thrive, and to build a secure future. Now let's talk about financial instruments. These are like tools in your financial toolbox. Two of the most common are stocks and bonds. Stocks are like tiny pieces of ownership in a company. When you buy stock, you're betting on that company's success. Bonds, on the other hand, are like loans you give to a company or government. They promise to pay you back with interest. Understanding these instruments is key to growing your wealth. They're your partners in building a secure financial future. Financial markets are where these financial instruments are bought and sold. Think of them as giant marketplaces for money. There are two main types, primary markets and secondary markets. The primary market is where companies issue new stocks and bonds to raise money. It's like the factory where these instruments are made. The secondary market is where you and other investors buy and sell existing stocks and bonds. This is where the real action happens, with prices fluctuating based on supply and demand. It's like a giant auction house for your financial future. Section 4. Financial institutions, the guardians of your money. Financial institutions play a pivotal role in our daily lives, often working behind the scenes to ensure the smooth operation of the financial system. They are the unsung heroes who keep the wheels of the economy turning. Financial institutions are like the referees of the financial system. Just as referees ensure fair play in sports, financial institutions ensure that the financial system operates efficiently and fairly. They enforce rules, provide guidance, and step in when things go awry. They make sure everything runs smoothly and fairly. Without them, the financial system would be chaotic and unreliable. They provide the structure and stability needed for economic growth and prosperity. Banks, credit unions, and insurance companies are all examples. Each of these institutions serves a unique purpose, catering to different financial needs and preferences. Banks offer a wide range of services, from savings accounts to mortgages. Credit unions, often member-owned, focus on providing favorable rates and personalized service. Insurance companies protect us from unforeseen risks, offering peace of mind. These institutions act as intermediaries between savers and borrowers. They facilitate the flow of money, ensuring that funds are available where they are needed most. By doing so, they help businesses expand, create jobs, and drive economic growth. They take your deposits and lend them to businesses and individuals who need capital. This process is crucial for the functioning of the economy. When you deposit money in a bank, it doesn't just sit there, it gets put to work, funding loans for homes, cars, education, and business ventures. They also provide crucial services like managing your money, offering loans, and protecting you against risk. Financial advisors help you plan for the future, ensuring that your investments align with your goals. Loan officers assist you in securing the funds needed for major purchases or business expansion. Insurance agents offer products that safeguard your assets and provide financial security. Trustworthy financial institutions are essential for a stable and secure financial system. They build trust through transparency, reliability, and a commitment to serving their customers' best interests. A strong financial system is the backbone of a healthy economy, providing the confidence needed for individuals and businesses to thrive. They are the guardians of your hard-earned money. By safeguarding your deposits, offering sound financial advice, and providing essential services, they ensure that your financial well-being is protected. In a world full of uncertainties, financial institutions offer a sense of security and stability, making them indispensable to our everyday lives. Section 5. Short-term versus long-term, money markets versus capital markets. Now let's talk about different types of financial markets. Financial markets are essential for the economy, providing a platform for the buying and selling of financial instruments. They can be broadly categorized into money markets and capital markets, each serving distinct purposes and catering to different financial needs. We have money markets and capital markets. These markets play a crucial role in the financial ecosystem, facilitating the flow of funds and helping in the efficient allocation of resources. Money markets are for short-term borrowing and lending, typically less than a year. They are highly liquid and are used by individuals, corporations, and governments to manage their short-term funding needs. Instruments traded in money markets include treasury bills, commercial paper, and certificates of deposit. Think of it as the quick cash market. Money markets are ideal for those who need immediate access to funds or want to park their money in a safe, short-term investment. They offer lower returns compared to capital markets, but come with lower risk. Capital markets, on the other hand, are for long-term investments, like stocks and bonds with maturities of more than a year. These markets are crucial for economic growth as they provide companies with the necessary capital to invest in projects, expand operations, and create jobs. They're where companies raise money for long-term growth and expansion. By issuing stocks and bonds, companies can attract investors who are willing to commit their funds for a longer period in exchange for potentially higher returns. Understanding the difference is key to making smart investment decisions. Investors need to assess their financial goals, risk tolerance, and investment horizon before choosing between money markets and capital markets. Diversifying investments across both markets can help in balancing risk and return. Think short-term for quick needs, long-term for building lasting wealth. Whether you're saving for an emergency fund or planning for retirement, knowing how to navigate these markets can significantly impact your financial success. Always stay informed and consider seeking advice from financial professionals to make the best choices for your unique situation. Section 6. Financial jargon: understanding the basics. In this section, we will break down some of the most common financial terms that you might encounter in your day-to-day life or in your professional career. Understanding these terms is crucial for making informed financial decisions. Let's decode some financial jargon, shall we? Equity means ownership. When you hear the term equity, think of it as a stake or share in something valuable. For instance, if you own equity in a company, you essentially own a part of that company. This ownership can come in various forms, such as stocks or shares. When you buy stock, you own equity in a company. Stocks represent fractional ownership in a corporation, and owning them means you have a claim on part of the company's assets and earnings. The value of your equity can fluctuate based on the company's performance and market conditions. Creditors are people or institutions who lend money. They provide the capital needed for various purposes, such as starting a business, buying a home, or funding education. In return, creditors expect to be repaid with interest, which is the cost of borrowing the money. Investors are those who put money into financial instruments, hoping for a return. They can invest in stocks, bonds, real estate, or other assets. The goal of investing is to grow wealth over time by earning returns on the invested capital. Investors must carefully analyze market trends and financial data to make informed decisions. Maturity refers to the date when a bond or loan is due for repayment. Bonds are debt securities issued by corporations or governments to raise capital. When you purchase a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Assets are things of value that you own, like your home, car, or investments. Assets can be tangible, such as real estate and vehicles, or intangible, such as stocks and intellectual property. They contribute to your overall net worth and can be used to generate income or provide financial security. Understanding these terms is like learning a new language, the language of money. Just as learning a new language can open up new opportunities and experiences, mastering financial jargon can empower you to make better financial decisions, plan for the future, and achieve your financial goals. Once you do, you'll be better equipped to navigate the world of finance. With a solid grasp of these basic financial terms, you'll be able to understand financial news, evaluate investment opportunities, and manage your personal finances more effectively. Remember, knowledge is power, and in the world of finance, it can also be the key to financial independence and success. Section 7. The economy's engine. Why the financial system matters. The financial system is the engine of our entire economy. It connects savers and borrowers, allowing businesses to grow and create more jobs. It helps people achieve their financial goals, like buying a new home or retiring comfortably. A healthy financial system is crucial for economic growth, job creation, and overall prosperity. When it's working well, everyone benefits greatly. It's the foundation upon which a strong and vibrant economy is built.